This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. And I have with me this morning Ty Andros, like old times, who is no stranger to most of our listeners this morning. Ty is the president of TraderView, publisher of the Ted Bits website, and writer and editor of his well-recognized newsletter, also named Ted Bits. Good morning.
Good morning, Gord. Thank you for having me. I look forward to it.
I encourage everyone who hasn't already to review the four-part series Ty and I did during his last visit on financial repression. We received just outstanding feedback on it. Ty, before we begin, I need to quickly take care of some mechanics. We have slides to guide our conversation this morning, and I would ask our listeners to open the slides to full-screen viewing. You need to open the slides to full-screen viewing to properly see the detail we'll be discussing, whether you're on SlideShare or YouTube. Both have an icon in the bottom right corner that by clicking it will open the slides to full-screen viewing. In both medias, there is a box below your viewing screen where you can make comments or ask questions. We value your feedback and questions, and Ty and I will try and address those in future shows. We have a lot to cover this morning, so I'm going to go right to our first slide, Ty, a slide that represents how well the U.S. is doing compared to other countries around the world. A comparison of GDP, or gross domestic product, as a representation of growth. And Ty, to me, when I look at this chart, if you believe this chart, then as my grandfather would have said, I have a bridge to sell you in Brooklyn. And we're going to show why this is flawed, the degree that it's flawed, and we're not going to just express this. We're going to show you exactly that. It makes you angry to look at this chart, doesn't it, Ty?
Oh, Gord, anger is something that I lost a long time ago. It's just, like you said, a bridge to sell, or we could call it the tooth fairy. The government is, anybody that's read George Orwell's 1984 or Animal Farm knows that those were prescient books, and we are living the embodiment of them. And the government no longer serves you, but has turned you into their slaves, and is beginning to find, they're feasting on the public and the private sector, and they pretty much killed them. But now we're in the end game. We're in the game where all wealth creation is going to cease, and is ceasing at an unimagined rate. And they have to cover up the consequences of their poor policies. And also what they do is I'll call it incremental lying, which we're going to show people. And the lying started, if you looked at John Williams, which we're going to, it started in the early 80s.
Absolutely right, from inflation, but it was even sooner than that. From a GDP standpoint, I think we go back into the 60s. And we are going to cover that because then, in fact, when we had issues with the GDP because of inflation and something called a deflator, we then started even managing the inflation, which Williams really does a great job going back into the 1980-81, which we're going to cover. I think it's important that our listeners who may not have studied economics understand why we're saying this regarding growth and GDP. Now, GDP stands for gross domestic product. It's a very simple formula, and we're not going to get into any maths here, but I want to show you so you know the components of what makes up GDP. It's made up of C, which stands for consumption, plus you add I, which stands for investments. Then you add G, which stands for government. And you can see a little table down below this month of the $15 trillion of gross domestic product for the country in absolute basis and in percentage basis. Then we take our exports, which is X, and we subtract our imports. So in other words, what we produce, we subtract what we import, which is a way of paying our bills. And that's the formula that we use to create gross domestic product. And you can see that we down here on the table this quarter, we had a 2.2% growth increase in GDP. and that's measured as real, not nominal. So we had a 2.2%, which sounds, it's weak, it's low, but it's at least positive, and that's how we calculate it. Now,
Gord, it's also a complete and absolute lie, isn't it? That's what we're going to show you, everybody, today.
I want to start with what the rules are. This is how the government reports it, and this is how our leaders talk to us and say things are good, things are bad. And from the previous chart, it says, actual, Ty, we're doing better than the rest of the world. Maybe there's a possibility that we're lying more than the rest of the world, but I'll leave that to our listeners. It's not like we don't spend a lot of time at this, right, Ty? So this is why we feel so strongly about this, because we spend time looking at it and can see the games that are going on, from hedonics to imputations to substitutions, and we literally pull our hair out.
Well, when I used to write about Bush, I used to call him Pinocchio. This administration and this current government that we have now makes him look like a saint.
I would argue as we go through this, it doesn't make a difference who's in the big seat, whether it's Democrat or Republican. They're all playing the game, and they have to. And we're going to show why they have to do that. They've put themselves in an impossible position. When you start, it's like when you start to lie, the lies build on each other and it locks you in. Ty, moving along, the chart I have up now is to take that a little further. And so you can see along the left that I have the C, the I, the G, the X, and the M with just a little bit more granularity. So, for example, C for consumption, we've broken it out with consumer goods and consumer services. And you can read down the I for fixed investments and increases in inventories. And by the way, if you stock a lot of inventories, that's good for the economy. But if you're it's called, we used to call it channel stuffing, and short term it makes your GDP look good. And each one of these lines, the games that are going on are really significant. But even before we get into the details, what I need to suggest or to say is, I know when I went and studied economics back in school, we didn't use GDP. We didn't consider it a valid measurement. And this, I'm sorry, I'm dating myself. I'm going back to the 60s. We use things such as GNP, GNE, which stood for Gross National Earnings, NNP, National Product. And the reason we went through all of this is because we looked at flow of product approach, which is the GNE. We looked at earnings and cost approach, which was the GNP. And for some reason, those have all been thrown away so that we can go to this nice, simple little formula here, so that we really don't get into the true measurements of profit and loss and really wealth creation. Because if you go to the other methods, and I'm not going to bore people with it, you really saw how wealth was created. GNP, GDP, does not show you how wealth is created. It's absolutely flawed. But for some reason, it's been adopted, is now standard, and nobody questions it.
Well, it's standard, Gord, because they have to mask the size of the collapse they have engineered through their poor policies. It's nothing less than that. And obviously the poor policies have, accumulated over 40 or 50 years. But Leviathan government really started when Bretton Woods II made us a society, based upon consuming more than you produce. And, we used to produce wealth by producing more than we consume. And of course, that's how the Chinese are growing right now. But and they're using the formula that made the West great, and the West has taken the formula that brought China low with Mao, and the results are predictable. The wealth of the world is rotated, including wealth creation.
If we take these components, and I'm going to start with government, it says, well, how do you grow your GDP in that formula? And you can see government down here. Well, the next slide will show you that this is government spending. And you can see that it's totally out of control and right through the roof. Well, Ty, this is great news. This says that GDP in this country is going to really start to accelerate as our budgets get further and further out of control. Now, it was down a little on this quarter, as you saw in the previous one. With them, remember, that's a comparative from quarter over quarter, but not on absolute. And that's where you get lost in some of these numbers, not on absolute volumes, just percentage change. But the greater that we can grow our spending on the government, the better for that formula. And you saw that it was right now showing 20% this quarter, government. If you get into our entitlements that are coming in the future, We're not going to have a GDP problem. And the other thing that it needs to really be seen is, well, you and I, when we run a business, we take our revenues and we subtract our costs to know what we've made. Well, if this is what the government's spending, you should in fact subtract out what they're taking in called taxes, but we don't subtract that. In terms of even looking at GDP, we just say, okay, we just ignore taxes, which is a crippling element of really growing wealth. The whole method of government is really called into question. And look, by the way, at the growth rate that we're going to see on taxation. That's clearly a cliff that's coming in front of us of the increases in taxes, which is a burden but does not show up in the GDP.
Just look at that breathtaking leap into 2013. My last newsletter, I talked about it. People are calling it tax-mageddon. And it just, if anybody thinks there's going to be any growth next year when they try to extract $550 billion more out of the private sector, like we started off, you got to believe in the tooth fairy, and we have bridges to sell.
Well, Ty, we're not going to spend a lot of time on this because there's shows on this. I want to make sure our listeners are just getting a sense. Okay, let's just move away from government, the magnitude of distortion there. Let's just talk about the investment, which I happen to believe, and I'm a big proponent in, the investment. But look at how that's being manipulated through things called imputations, which we really want to spend time on. And what I'm saying here is, this is this quarter's changes, and you can see it's broken up into category. Well, notice the red, which is in the little box, is stocks. That's 0.6 as the contribution for this quarter's 2.2 growth in the GDP. So over, a third, shall we say. And what was that? That was the increase in the stock market. So if the stock market goes up, it's great for GDP. But if it goes down, well, it's not so good for GDP. So if we took out that, it was a dismal quarter. So no wonder 33 Liberty Street in New York is spending so much time making sure on no volume that our stock market stays up. So there's some questions even in how we look at the I element. Well, then, another one I'm a big supporter in is the exports minus the imports, the X minus M. Well, that's fine, but if you look at this particular chart, it shows you what's wrong with it. This is showing exports and imports, and they're both falling off. And they always precede what happens with the GDP, as in you see it then falls off a cliff. But it doesn't show up on that previous formula because we were subtracting the difference. So if they're both falling, and in fact our imports suddenly are not at the same growing at the same rate, that's very positive. We think it's great, but in fact it distorts what's really happening here in the magnitude of our problem. So it's just another example. Now let's talk about the consumption, which is 70% of our economy. 70%. First point in that is, for anybody that's studied math, you know that all formulas aren't necessarily linear, and they have discontinuity in them. And so what's happened is, I could argue that maybe this formula, when consumption was less than 30%, was a possibility. But when you get to 70%, it isn't valid to consider all that consumption as in fact growth or creation of wealth. It just defies any kind of logic. And that's what we're doing. An example of that is when we went through the housing bubble. And I'm not talking about prices of housing. We looked at the GDP, and we included all of the HELOCs, Ty, and you wrote extensively about this. I know you did. And HELOCs are home equity loans. And the amount of home equity loans that were being built up were being taken out, because remember, that is now considered investment. When we took it out, we had no growth.
It's just counting debt as wealth creation, which it's not. It's bringing consumption forward. It has nothing to do with wealth creation. It's an illusion. It's a okay, well, we take this growth, but we've got to pay it back compounded later. So it's a subtraction from growth when these things have to be repaid. And obviously we're seeing that as the housing market deleverages.
So we have McMansions, Ty, all across this nation that are producing what? What wealth are they producing? Now, building out this massive McMansion that we did for a decade in regards to housing did create there is an element of wealth in it, but not to the magnitude. Now, if we had spent those trillions of dollars on factories or services that produce wealth for export.
Produce more than you consume to create wealth.
But you see, our GDP doesn't even come close, doesn't even in the ballpark of properly measuring this. And so I just wanted to kind of give a perspective. Now, let's get into more of the details, because I think this is really important how it's done. And it's what that old expression, the numbers don't lie, but statisticians do. And so what's happened is we've been massaging this data and changing it. So not only is the overall formula flawed, but even how we report the numbers within the formula, we've now taken it to another level of excellence. And we use things called hedonics. We use things called substitutions. Use things such as imputations to do that.
Well, it just, Gord, it's all, I'll call it notional. You know, it breaks the link with the past. I mean, the idea that you're substituting chicken with steak means that we're just Xing out the true rate of inflation, because steak is what we were measuring. And hedonics is the same way. You have a television set that stays the same price, and it has some more functionality. So they get to subtract, I'll call it that efficiency from the headline inflation number. And so it's, just actually the propagation of government lies.
A couple points for those that aren't familiar with hedonics and substitutions before we get to imputation, because both of those, hedonics and substitution, a lot of people are angry and frustrated with, but for some of our listeners, you may not be aware. So let me expound that a little bit if I could. What's flawed here, it's really something I call unidirectional inflation, so that what you have can only go one way. It doesn't go where inflation starts to build. It only kind of works if you can keep the inflation down, and how you do it and how you measure it. And hedonics is the first example. And the example that jumps to my mind as a technology guy and an old manufacturing guy, if you were to take ABS brakes, automatic braking system, or now what's going to be called dynamic stability control in the near future, when these first were introduced, they were terribly expensive an option. And as time progressed, the chips that made these possible dropped in price. Now they cost so little, it's standard in every car. Matter of fact, I think it's even mandated. And it's the same with airbags. Soon you won't be able to buy a car without both of these. But the government looks at that because of the change in the quality, and versus it's a quality improvement, you have to measure it. And therefore what you do is you have to measure it against the original price. So they go back and they adjust it. Even though you're getting it cheaper and cheaper and cheaper, they say, no, that's a quality improvement. And therefore, we have to adjust the price. To you, it's not, it's a quality improvement. It's also cheaper. And, as a former, manufacturing guy, you can't confuse inflation with industrial economics of scale. Or, earlier versions of products cost more because the first units are manufactured in small batches, the R&D costs included. And as any product moves from early adopters towards mainstream, prices decrease, quality and functionality improves, commoditization occurs, and this is to be expected. It's called the experience curve. It's called Moore's Law, and it's called other things. The government calls it hedonics and completely and totally misrepresents it. And that's because they can do anything they want, frankly, because they're not charged with fraud. This is garbage, but they do that. That's hedonics. And then we get into substitution.
Just think of a smartphone and chip manufacturing and the ability that we used to have GPSs, and it was a separate size of your smartphone. Now they just print that on the circuit board and add it to the smartphone. It just, the technological revolutions of printed circuits that are millionths of a thickness. It's wonderful, but I wouldn't call it reduction of inflation.
It's a variation of the old trick of comparing present with the past instead of the present. And it's the sleight of hand that's so well done here. And you never see any of this in these calculations in a previous chart I showed you. But that's what's in buildup of these numbers. And they go through all of the items that go into consumption and do this hedonics adjustments on them. You have no idea what's being built in there of what the quality improvement is and therefore what your cost is. You buy a PC today and pay a certain amount. They adjust that based on what it used to cost and therefore how inflation should be measured or not measured. Then you have substitution, which is something different. And that's, as you said, you substitute chicken for steak because you can't afford steak because your job's been cut and you buy more chicken than steak. It's adjusted.
Well, the whole thing there is it broke the link We were measuring steak before. Okay, chicken isn't steak. So how do you compare? Say we've had a no rise in prices because people haven't quit eating beef. Okay, they haven't. Anybody that goes to the grocery store, it's sticker shock. I mean, the price of beef in the last year is up maybe 50 to 100%. The price of pork is up 50 to 100%. The price of grains are up. So what do? You quit eating corn so you can eat a little bit of wheat because the price of wheat went down? Come on. Okay, it totally breaks the link between what you're measuring.
Kai, we're going to talk about in our second show exactly that. Then take these numbers and then adjust based on what they think the spread is of how much you're consuming for gas versus how much you're eating, and then adjust the consumption usage. So you're not only adjusting you went from steak to chicken, then is how much food you're eating in comparison. Basically, there's a giant plug numbers. You can get anything you want. So a lot of these are generally well understood, but I don't think people understand another concept called imputation, which is getting very little press. And the chart I have up here is one that you brought today. And I'd love you if you could take us through this, Ty, because it really brings it home to me.
Well, Gord, this is something that really is very well buried. I actually got this from a guy over at Trulet Prebon. And I've forgotten his name, but he just did an unbelievable series. And what he did was he went into the Bureau of Economic Analysis and took out all of the adjustments, what I'll call, and that they put in, and they call it GDP, but no dollars changed hands. It's completely notional. It's a ghost economy, but it's presented to the public as if it was a headline. And when we sit here and imputed rental income is a good example. Look at it. It's 1.2 trillion. But what is that? I'll tell you what it is. It is somebody that owns all of their home free and clear. And if they could rent that home out for $2,500 a month, they're counting that as $2,500 a month of GDP, even though nobody was paid. Or if you had a mortgage and your house was 50% paid for, the same example, they would count that up as $1,250 worth of income, because they don't count the half that you owe, but they count it as a headline number. You go to employment-related imputations, and what that is that is the government telling you that the medical benefits that are paid to you by your employer, even though you don't pay for them, is GDP. Or financial services, it's got it at 501 billion. Well, that's, people have free checking accounts, so they measure what you would have had to pay if they were actually charging you for those. And they say this is GDP, even though you didn't pay a cent for them. And on and on and on. But the bottom line of this is 2.277 trillion, which is almost 20%, 15. Well, we got the number there. 15.7% of the GDP is not any kind of commercial activity at all. It's not money changing hands. It's not money going from one bank account to another. It's completely notional. It is absolutely has no economic benefit. It's just a masking of I'll call it denouement of the economy. All of these numbers that we're going through this incremental change is used to mask the destruction that government policies have done to the economy. And to because people would be screaming if they understood this. If they understood this, they would be screaming for the repeal of all of these regulations and all of this horse crap. And because all of these numbers are used to mask, I'll call it the poor governance we've had for 40 or 50 years since we came off Bretton Woods. And to create a false sense of progress in the public, when actually we haven't been progressing at all. In fact, they're destroying the private sector and the ability to create wealth in this country, and it's collapsing, and it's there only to mask their collapse and to mask their money printing.
In the, as we said earlier, in the 60s, we started changing how we measure growth. Then in the early 70s, we got into further problems. We took ourselves off the gold standard and went to a total fiat currency. And then we went along, and by the early 80s, we started massaging inflation because we were printing, and we're going to get into that in the next show, and the magnitude of what we had to do to hide it. It has been one continuous distortion upon another. And what it's led to, and we'll get to this in our third show, is consequences when you make decisions on bad data. Whether you understand it's bad data or not, decisions of public policy is formulated where it leads you to. And if you make enough bad decisions, you're left with no decisions. Ty, we're coming up against our hard line, and I want to make sure that because we could spend hours on and just each of the kinds of comments we've made here to really give our listeners a lot more detail. But this is the summary of what you've just shown, just on imputation, without backing through all of anything else we've talked about. That 15.5 trillion that I showed on the first chart in that great growth is really not 15 trillion. It's only 13 trillion.
It's only 13 trillion, and you have to take this number a little bit further, and you have to say, well, if it's 13 trillion and we have on balance sheet debt of 15 trillion, debt to GDP in the United States in real terms is about 116%, not the 100% that we're being told it is. And then, of course, we had to put in these numbers to show you what the chosen one and the socialists have done since they took office. You know, there was a corrupt supermajority in the first 2 years of the latest administration, and it was corrupt supermajorities. But what they did was they expanded government by 25% in literally a stroke of a pen. And they borrowed $5 trillion to create nominal growth of $720 billion. So what we're seeing there is they've spent $6.94 to create $1 worth of growth. And of course, the $6.94 has to be paid back with interest.
I think, as the chart says, Ty, would you invest in America if this is how you were running your business and reporting it as on a profit and loss in the balance sheet? I think your auditors would be hemorrhaging before they would sign off on the books. Ty, moving along as we wrap here, going back to the chart I showed when we began, that in fact that gold line is clearly not rising. That gold line is actually falling off closer to what all the other countries around the world are, and is down. And in the next session, we're going to talk about moving from nominal to real because of what they use, something called the deflator, which even distorts this much more dramatically.
Well, there's no recovery. If you took the imputations out, the economy's still in free fall. The imputations and then the borrowing, the economy has not recovered at all.
We never left the recession, and I would use deeper words than that to describe what we're in. Can't manage something if you can't measure it. And if you're measuring incorrectly, you're going to make bad decisions. And whether this is known, understood, or whatever, we've got ourselves locked into something that's a terrible situation. And we're going to take it again. In the next session, we're going to talk about inflation and what it means. And then in the third session, we're going to talk about consequences. But this is all part, for our listeners, of the roadmap that Ty and I will be taking you through over the next few months to show you the consequences of that and why it's leading us to more centralized planning, something that we refer to as Crony Capitalism, and that is why this would be allowed to happen. How could this happen in America? And this roadmap is taking us to something that we, neither one of us, like what we see.
They're destroying the incentives. That's why people don't want to get up in the morning with a spring in their step and go out and produce. It's the wholesale destruction of wealth creation.
We have to wrap. Any last comments you'd like to make? And also how people could learn more about your services, the products, the things that you do.
Well, I've got a website called tedbits.com. We're just really launching right now, and it's global macro commentary through the Austrian lens. And I also am an absolute return alternative investment specialist. And what that means is I help people put together investments that short circuit the printing press and preserve purchasing power first, and that's the gold and silver backing, and we use options, and then putting together multi-advisor portfolios that can make make money when markets decline as well as when they go up, and they have a great potential because, as you know, Gord, everything is mispriced, and there's a lot of, I'll call it, market clearing events in front of us, it'd be like a firecracker. But if you're not prepared, you're going to be a victim of them. I mean, I just can't tell you that if you look in the rear view mirror of investing and think that you can use those techniques that have worked for 40 or 50 years since the late 70s, you are going to be immolated. And so I'm what I'll call an applied Austrian economist. And I show people how to use von Mises and Hayek and apply what they've taught you to preserve and build wealth during this upcoming debacle.
Ty, thank you very much for your time this morning, and we'll be back together in a couple of days, and we're going to talk about inflation and deflation on these misstated growth numbers. Talk to you then.
Thank you for having me.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.